And I think 2023, we had expected by now to be in recession, which has not come.
Yep.
The labor market is very strong. The consumer spending is very strong. I think what was underestimated was the extent of stimulus there was in the system, both in terms of the fiscal stimulus, which came from the final months of the Trump administration, first few months of the Biden administration. And don't forget, the balance sheet of the Federal Reserve doubled from bloated levels from the beginning of COVID to the beginning of 2022. And we had zero interest rates for a long period of time. So everybody loaded up, and 1.5 years later, after the tightening began, I think we are still not back yet. But the point I make and I say to my clients is that recession is something that has been postponed, but it's been delayed, but it's not denied. So I think we are still going to see signs of a recession. And what worries me the most is, as you have interest rates having risen and the balance sheet of the Fed is still being tightened, it did not pause. And when the two of them go together, that there is something that's going to break in the system in the first half of 2024.
So how do you then distinguish between what a lot of people will say right now are signs that we're heading toward a soft landing, and that you're in the camp here that recession is still a possibility?
Yeah, I do not believe in soft landing, Molly. And I would think that when you look at what has happened in past history, it all looks very nice until the thing gets out of control. It happened with 2007. And toward the end of the year, we had the Fed chairman, Ben Bernanke, say to us that the subprime mortgage situation was just a $50 to $100 billion problem. We found out in the next year, 2008, it was just a terrible situation, not just a minor problem. Same thing happened in 1998 when you had long-term capital management, a small hedge fund, which was never going to fail because 2 Nobel Prize winners ran it.
Ex-Salomon Brothers.
Right?
Thank you.
And it was done with, again, with no leverage, it was thought, but then they had enormous amount of leverage and a lot of risk, and it failed as well. So it is all, I like to say that it is all lit up until it darkens, the opposite of what we normally say.
Is there some event out there that you're concerned could be that long-term capital management moment, or could be the subprime issue for in 2007, 2000? Is there something out there that concerns you in terms of catalyst?
Paul, I have a few candidates. One is, I had said before the March regional banking crisis there might be a credit event, but we survived that. It was a credit event. The next one, my top candidate, is a bigger banking institution, maybe an institution which is medium-sized. And why do they suffer? They suffer because they loaded up on long-dated bonds when Jerome Powell told us inflation is going to be transitory. So in that case, I should buy 10-year treasuries at 2% because I'm expecting it to go to 1%, right? It didn't. It went the other way. So that's one candidate.
Wouldn't that have already happened, though, by now? If that were to blow up, similar to the small banks that we saw in March?
Not yet, Molly, and I'll tell you why I think it hasn't happened yet. If you look at the bank numbers, the deposits with the U.S. banking system has been steadily going down. The delinquency rate is starting to pick up, and the balance sheet is being reduced as far as the Fed is concerned. When you put them all together, suddenly something clicks. It doesn't happen gradually. So which is why I think timing-wise, I would look for the first quarter of 2024 is when something breaks again. So we talked about commercial real estate as the third. You can also have, again, a crunch on the credit side, which is already taking place. My final candidate is a repeat of what happened in the United Kingdom, September, October of 2022. Bond yields rise a lot. There it was the gilt yields, and here we are talking about treasury yields, and pension funds incur huge losses. They have not done well in terms of general performance, and that situation worsens and puts pressure on the Fed.
One of the things as we think about this economy in a hard landing, soft landing recession is the labor market. And we got some more labor data today. Initial jobless claims came in at 209,000, below expectations, less than we saw last month. I mean, this labor market seems to defy most logic in how robust it is. What do you make of the U.S. labor market?
Yes, the labor market so far has been very robust, and I think the reason that has been the case, once again, traces back to the amount of stimulus. There was so much money that you were able to give. And also the shortage of labor, which took place due to COVID, with one part of the working force, typically the wives, who stayed behind to provide childcare. That in turn reduced the workforce. I think we are just coming back to it. But if you look at the layoff numbers, Paul, you're seeing that after a period of very strong numbers, despite today's initial jobless claims, the unemployment has started to rise.
Yep.
And they don't, once again, it doesn't rise gradually. And history tells you that when it rises, it just surges suddenly. And I wouldn't be surprised to see that happen in the next 2 to 3 months.
So let's go back to these stimulus payments, because there right now is such a debate in economic circles of how much excess savings the consumer has. I feel like I see a different report on this every day, that savings are dwindling, there's nothing left. Another one will say there's more than we really thought, and that's what's giving the consumer still a lot of gas right now to keep spending. And same with on the credit side as well. You mentioned delinquencies are picking up, and we've seen credit card balances getting higher, but as a share of total deposits, still very low. So how do you assess right now these conflicting messages about the health of the consumer?
That's again a very timely question. And I would answer you, Molly, by saying that while the aggregate numbers in terms of delinquency, the aggregate numbers still seem really benign. There is a difference across income groups, meaning the numbers are showing recently that even the consumer spending, a good chunk of the increase is coming from the highest 1 or 10% maximum in terms of the income groups. And the lower income groups are actually cutting back. Delinquency wise, the credit card delinquencies are the first to show up. And the reason is it is easy for you not to pay. You don't have to go and ask anybody to give you a loan. And so that is starting to happen. The next, if it starts to happen also in terms of what happens to the payments to the banks, then I would be even more concerned. But it is already happening with low middle income groups. It's not happening yet with the high income groups.